So what makes gamma exposure such levels a great tool for option traders?
What gamma levels tell us is where market makers will react. The market will react at certain levels in a predictable fashion. It's not backward looking like technical analysis, trying to project into the future. It's forward looking, telling us what's going to happen where, given certain conditions.
I look forward to digging into this, and this is an area I know very little about myself as well. Before we go on, I think we briefly should explain what actually is gamma.
That's a very good point. So let's talk about gamma. And to do that, we have to backtrack a minute and dust off our options Greeks 101. We know that delta, broadly speaking, is how much the price of an option is going to change with the dollar move in the other. We also think we know it's not really true, but it's kind of true-ish, that delta is going to tell you, going to sort of approximate the chance of an option expiring in the money and out of the money. Certainly as put sellers, we come in here with that conception, partially a misconception, that that's actually what delta tells us. So delta is a derivative of price. Price moves, and then delta tells us how much our option value is going to change based on that move, and how likely it is to expire in the money or out of the money. Gamma tells us the rate of change of delta. And so if a stock moves up and down 2%, well, how much will the option price change? And that's delta. And against gamma, and that's nonlinear. So, creep off the top of my head example, Procter & Gamble. Procter & Gamble, out of the money, put, if you sold it, and the stock moved down a couple dollars, $2, the option would barely buy. If you bought a call and it went up $1 or $2, the option would barely buy. It doesn't have a lot of volatility in it. It's not going to move. That's gamma. It's going to tell us how much delta is going to change. Versus NVIDIA, if it moves up, those options have a lot of gamma, and it's going to move one way or the other really fast, and you're going to get a convex move, a nonlinear response. Okay? So gamma is how much delta is going to change and how sensitive the price is to that gain. So where the point of convexity is.
Because the market makers want to be delta neutral at all times.
Yes, market makers want to be delta neutral at all times. So their job is to be delta neutral. And so the opposite side of that trade, which is probably the more classical way that people looked at gamma exposure in the past, was institutions mostly broadly, especially in the indices, sold calls, bought puts. And that created hedges columns. So market makers were long gamma above where we were and short gamma below. So that's the negative gamma that people talk about. Short gamma. Okay? So market maker sells the put, he's short gamma there, and shorts stock or the index to balance his exposure. So let's get started off with that, since I'm here anyway. Let's get started with that. So now what happens when the stock goes down? Well, now he's more exposed to that risk. He's not short enough. That he's short, because I bought it from him, he sold it to me. So he sold the put to me just like you sold the put to the market maker. You know, just think of it that way. And the stock goes down, you're losing money. Well, he's not in the business of losing money. What he's going to do is keep shorting shares to just balance his risk. So he's not taking on that risk. He's basically rolling it. You can think of it, not really. He's basically dollar for dollar taking that risk off as it's moving against him by shorting.
I understand that you have two zero DTE strategies that you trade a lot, butterflies and iron condors. Assuming this picture is what you see before the market opens, how would you plan your butterflies and your iron condors, zero DTE, accordingly, if this is the picture at the opening of the day?
Seeing this picture at the beginning of the day, let's do the iron condors. I'm looking to sell puts below this solid level if I can get juice. If the premium doesn't pay, let's just say hypothetically a 20 wide gives 10 cents. Obviously, I'm not going to do it. That's not where we're going. So, okay, these people won and that's that. But let's just say we're, somewhere in this neighborhood and there's some kind of decent premium down there. I'm going to sell down here.
And where would you put the calls in the iron condor?
The calls, I'm going to look to sell above this level. Now, again, depending where we are in relation to this is how far away I'm going to go. And a lot of times, unlike some people that worship at the altar of symmetry and delta neutrality, that want to have 10 puts and 10 calls sold and collect the same premium or the same delta, that's not what I do. Sometimes it just happens to work out that way. That's typically not the way a day unfolds for me. Down here, I'm going to slam it. I'm going to sell, let's just say hypothetically, I tend to sell 20 wide iron spreads, but it doesn't matter if it's 10 wide, 20 wide, 15 wide, whatever your risk tolerance is. I'm going to sell my usual tranche of 5 to begin with at the open, even at the bid, at the market to get in. If we start going down, I'm going to add here. I'm going to be confident to add on pullbacks to what I'm selling below this large level. On top, I'm probably going to wait to see how, if we come into this zone, I'm expecting this run up. So I'm going to wait to see how far up we run here and how this acts as a stall feature or not. I'm expecting it to act as a stall feature, but this could get overrun.
So let's sum up briefly. How would you sum up this? And particularly, what would be your 2, 3, 4 most important takeaways that you want the audience to remember from this interview?
First thing that I'd like the audience to remember is that market makers' gamma exposure, GEX, is going to drive a lot of the intraday price movement that we see in the SPX, and that it's not trying to predict, it's a prescription. It's going to happen. And so there's a certain predictability in there and a comfort to it.